Macroeconomic Update, April 2020. The month of April 2020 was a mixed month for the capital markets. Equities registered strong growth across all major markets on back of large monetary and fiscal stimulus announced by most major countries. However, in the fixed income market, credit concerns rose due to lack of clarity regarding moratorium on NBFC debt and were aggravated on back of announcement of winding up of some debt schemes by a large mutual fund. Further, the spread of COVID-19 continues to remain a concern, with the number of infected cases globally increasing nearly 4 times in the last 1 month to 3.6 million by 3rd May 2020. In India, though numbers are rising, they remain relatively low in absolute terms considering the large population. The total infected cases in India reached over 42,000, up from around 1,400 cases as on end March 2020. The government has extended the lockdown to 17th May 2020, but with some relaxations in areas where the number of cases are low. RBI announced a number of measures in April 2020, primarily aimed to address the stress faced by non-banking financial companies, improve liquidity, nudge rate transmission, and encourage credit growth. Following are the measures taken by the RBI. The RBI reduced the reverse repo rate by 25 basis points to 3.75%, while keeping the repo rate unchanged at 4.4%. To support liquidity for NBFCs, it announced targeted long-term repo operations with 50% carve-out for small and mid-size NBFCs. The fund availed under this operation has to be deployed in CPs, NCDs, or bonds issued by NBFCs only. Out of the aggregate amount INR 50,000 crores announced, it has already conducted INR 25,000 crores, for which response was muted and approximately only 51% was subscribed. Special refinancing facility of aggregate sum of INR 50,000 crores to National Bank for Agriculture and Rural Development, Small Industries Development Bank of India, and National Housing Bank. To support liquidity of mutual funds, it announced a special liquidity facility for mutual funds. Under this scheme, banks are allowed to borrow from RBI at repo rate, and amount availed has to be utilized for lending to mutual funds, undertaking outright purchase of, and/or repos against the collateral of investment-grade securities held by mutual funds. For detailed comment on measures announced by RBI and its possible impact, please refer to our comment published on 20th April 2020, Monetary Measures 2.0. Consumer Price Index fell in the month of March 2020 to 5.91% year-on-year in March 2020, down 66 basis points month-on-month. The fall in CPI was driven due to fall in food inflation, mainly vegetables, especially onions, which moderated to 7.82% year-on-year, down 1.63%. Fuel inflation was marginally higher than last month. However, with sharp fall in crude prices, it is likely to moderate going forward. The core CPI inched up slightly on back of higher personal effect inflation, but remained within comfortable range. Core CPI has remained below 4% for the past 6 months now. Lower fuel prices, weak aggregate demand, and improved supply of food grains and horticulture are likely to keep inflation benign, except for supply disruption, if any. Wholesale Price Index also fell to 0.9% in March 2020 from 2.3% in February 2020, driven by lower fuel inflation, soft manufacturing inflation, and moderation in food articles inflation. Fuel inflation turned negative to minus 2.5% year-on-year, on back of fall in crude prices, whereas food articles inflation fell to 4.5% year-on-year. Inflation of manufactured products softened slightly to 0.3%. IIP for the month of February 2020 jumped to 4.5% from 2.1% a month ago. Mining grew by 10%, while manufacturing grew by 3.2%. Electricity production also increased by 8.1% year-on-year. By usage, the intermediate and primary goods grew by 22.4% and 7.4%, while infrastructure goods turned marginally positive to 0.1% after being negative for the past 6 months. Consumer durables and capital goods contracted by -6.4% and -9.7% respectively. However, going forward, IIP is likely to contract significantly on back of lockdown imposed by the government since 25th March 2020. The core industries registered degrowth of 6.5% in March 2020, driven by contraction in all segments except coal. Cement production contracted by approximately 25%, while steel and fertilizers fell by 13.1% and 11.8% respectively. Electricity production fell by 7.2% too. Recent data indicates electricity generation has fallen between 20 to 25% in April 2020 due to lockdown. In March 2020, the impact of lockdown was largely restricted to the last week only. Thus, with lockdown being imposed for a full month in April 2020, the core industry's growth is likely to weaken further. India's trade deficit for March 2020 was marginally lower at approximately $9,758 billion compared to last month. Net gold imports fell sharply during the month on back of lower volumes and weaker demand. Net oil imports widened slightly as the benefit of lower oil imports due to fall in oil prices was set off by weaker oil exports. Excluding oil and gold, the trade deficit increased as lower imports of electronic goods was more than offset by weaker exports of engineering goods and chemicals. INR appreciated by approximately 0.7% against USD and closed at 75.1. Due to disruption in demand and excess global supply, crude oil prices have fallen sharply over the past 2 months. Further, weak gold volumes and likely fall in non-oil, non-gold imports should lead to lower trade deficit and thus improving current account position going forward. This is likely to offset partially by weak exports and lower remittances from abroad, especially from Gulf countries. Commodity prices witnessed mixed trends during the month. Brent crude prices fell below $20 per barrel due to concerns over excess supply and storage, but ended the month at $25, up approximately 11% from the last month. Gold prices ended the month at $1,687 per ounce on back of demand for safe haven assets and increase in global liquidity. Given the evolving situation, it is difficult to assess the exact impact of coronavirus on growth. If the spread of the virus is contained within a reasonable time, impact on growth is likely to be limited for the short term, and it should recover in the second half of FY21. Stimulative measures announced by major global central banks and governments of many countries should help counter the impact on growth to a certain extent. While immediate impact of disruption is negative for India in the near term, but once the spread is contained, India stands to benefit in this environment, in our opinion. Amongst the emerging markets, India is uniquely placed as most major EM economies have high dependence on exports and/or are net oil exporters. Thus, weakness in global growth and fall in oil prices is likely to hurt these economies significantly. But India is a net importer of oil and stands to gain significantly due to fall in oil prices. Further, India's dependence on exports is relatively limited as compared to other EMs. Thus, once the situation stabilizes, India could see relatively stronger recovery. Further, disruption in the global supply chain caused by this event has highlighted the risk of overdependence on a single country. Thus, over medium to long term, many global MNCs are likely to consider diversifying their manufacturing operations from China, and India could be a likely beneficiary given the low corporate tax rate, skilled population, relatively low wages, and a large domestic market. For more on this, please refer HDFC MF Yearbook 2020, published in January 2020, and available on our website www.hdfcfund.com. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.